In 1999, a company called Pets.com raised $82 million on the public markets. It had a sock puppet mascot, a Super Bowl advertisement, and almost no revenue. 9 months after its IPO, it was gone. In 2023, an AI startup with fewer than 50 employees and no commercial product was valued at over $1 billion, not because of what it had built, because of what investors believed it might build. Now, before you switch off, this video is not about whether AI is real. It is. The technology is genuinely transformative. This video is about something more specific and more urgent. We have been here before, not approximately, not loosely. The pattern unfolding in AI investment right now matches a historical sequence that has repeated, with almost mechanical precision, across 4 centuries of financial history. And here is what that pattern tells us. We are not approaching a potential bubble. We are already inside one. In late 2025, the Case-Shiller price-to-earnings ratio for the U.S. market exceeded 40 for the first time since the dot-com crash. Ray Dalio, founder of Bridgewater Associates, said publicly that AI investment levels are very similar to the dot-com era. Even Sam Altman, CEO of OpenAI, stated in 2025 that he believed an AI bubble is ongoing. The question is not whether the reckoning comes. The question is whether you will be positioned on the right side of it when it does. History has a playbook for this. Let us open it. By 1997, the internet was undeniably real. Revenue was growing. Amazon had gone public. Early investors had made extraordinary, legitimate returns. But something had shifted. The capital flowing into internet companies was no longer tracking actual business fundamentals. It was tracking a story. The story was, the internet changes everything. Therefore, any company attached to the internet is worth backing. By 1998, that story had become self-reinforcing. Every successful IPO validated the last. Analysts invented new metrics, eyeballs, page views, mind share, because the traditional ones produced numbers that could not justify the ticket prices being paid. The NASDAQ had already risen over 200% from its 1,995 base. The crash did not come until March 2000. That means the bubble ran, visibly and measurably inflated, for at least 2 years before it broke. Now look at AI. The technology is undeniably real. Large language models and generative AI represent genuine capability shifts. Early investors, those who backed NVIDIA when it was primarily a gaming chip company, or Microsoft when it deepened its OpenAI partnership, have made extraordinary, legitimate returns. But capital is now flowing into AI at a rate that has long since detached from measurable fundamentals. On October 29, 2025, NVIDIA became the first company in history to cross the $5 trillion market valuation, reaching that milestone just 3 months after crossing $4 trillion. Its revenue is real and growing, but its ticket price requires years of uninterrupted dominance in a market where competition is intensifying daily. According to PitchBook, nearly 2/3 of all U.S. venture capital deal value in the first half of 2025 went to AI and machine learning startups, up from just 23% in 2023. The word AI in a pitch deck is doing precisely what Internet did in 1997, unlocking capital regardless of the underlying business model. But here is what the numbers behind the story reveal. OpenAI, the company most synonymous with the AI revolution, projected $13 billion in revenue for 2025 against an $8 billion operating loss. It expects those losses to grow to $17 billion in 2026 and $35 billion in 2027. It has committed to spending $1.4 trillion on data centers over 8 years, funded largely by debt. Total revenue across the entire AI industry in 2025 is estimated at less than $50 billion, against over $1 trillion in investment. The gap between what AI costs and what it currently earns is not a rounding error. It is the gap. An August 2025 report from MIT's Media Lab found that despite $30 to $40 billion in enterprise investment in generative AI, 95% of organizations reported zero return. A February 2026 National Bureau of Economic Research study found that 90% of firms reported no measurable AI impact on workplace productivity, even as executives projected meaningful gains ahead. In dot-com terms, we are no longer in 1997 or 1998. The speculation phase is fully inflated. We are somewhere in late 1999, and the most dangerous phase of the cycle is not behind us. It is still ahead. In the 1840s, Britain experienced what historians now call railway mania. The technology was real. Trains genuinely transformed Britain. Goods moved faster. Cities connected. Industries grew. Early investors made extraordinary returns. But by the mid-1840s, Parliament had approved over 9,000 miles of new track in a single decade, backed by capital that did not yet exist, serving routes that would never generate a profit. The speculation phase looked almost identical to what we are watching now. Hundreds of railway companies launched. Investors poured money into routes before a single track had been laid. New metrics were invented to justify the ticket prices, projected passenger numbers, estimated freight volumes, theoretical returns that required a future that had not arrived yet. When the crash came, it was devastating. Thousands of investors were ruined. Capital evaporated. But the tracks remained. The physical infrastructure, laid with speculative money, stayed in the ground. And the companies that had built real routes, with real passengers paying real fares today, went on to define British commerce for a generation. The bubble destroyed the speculators. The survivors inherited the infrastructure at collapsed prices and built empires on it. The dot-com crash followed the same script. $5 trillion in market value evaporated between 2000 and 2002. But the fiber optic cables laid during the mania, sold in bankruptcy for pennies on the dollar, became the physical backbone of the internet that Amazon, Google, and the modern digital economy were built on. AI will follow this pattern. The data centers, the chip fabrication capacity, the foundation models being built now will outlast the speculation phase. An estimate from Morgan Stanley put global data center spending between 2025 and 2028 at $3 trillion. Half of it is being funded by private credit. That infrastructure will not disappear when the story breaks. The question is simply, who will be standing to inherit it? History gives us 4 ways to identify them. If you have seen our previous video on the dot-com bubble, you will know that avoiding leverage and owning profitable businesses, not stories, are the 2 most consistent survival traits across every major mania in history. Those are worth revisiting there. Here, we go further into the strategies that the railway crash, the dot-com collapse, and centuries of prior manias have repeatedly validated. Diversify out of tech, but into what, specifically? This is where most financial advice becomes frustratingly vague. History is more specific. After the railway mania peaked, British investors who had preserved capital moved into 3 categories of asset: hard assets, land, gold, commodities, which held value precisely because they were indifferent to the story driving speculation. Consumer staples, businesses selling food, household goods, and basic services whose cash flows were boring, durable, and almost entirely disconnected from the mania's fate. And energy, specifically the coal companies that powered the railways, not the railway companies themselves. The infrastructure of the infrastructure, which profited from the boom without carrying its valuation risk. The dot-com era produced an almost identical rotation. Between 2000 and 2002, as the NASDAQ fell 78%, gold rose. Energy companies, largely ignored during the tech boom, quietly compounded, consumer staples held. In early 2026, analysts at Yahoo Finance are pointing toward the same pattern emerging. Defensive heavyweights, healthcare, energy, consumer staples are being flagged as potential sanctuaries if AI enthusiasm wanes. Analyst Tom SI noted in January 2026 that the market is aggressively sorting winners and losers, and that investors seeking stability are already rotating toward companies with durable cash flows outside the AI spending cycle. In the current cycle, the equivalent of the coal company is the utility provider serving data centers, or the industrial commodities supplier, copper, rare earths, essential to chip manufacturing. These carry none of the speculative valuation. They are not exciting. They are durable.
Learn to recognize the speculation phase while you are inside it. This sounds easier than it is. In every mania, the speculation phase feels like clarity, not delusion. The certainty is the warning sign, not the doubt. History gives us 3 markers that have appeared in every speculation phase across 4 centuries. New metrics replace old ones. When investors stop using traditional valuation tools and start inventing new ones. Projected passenger miles in railway mania, eyeballs and mind share in .com, total addressable market, projections assuming entire industries restructure within 5 years in AI, the speculation phase has arrived. The quality of companies receiving capital declines visibly. In 1998, venture funding flowed primarily to companies with some revenue or a credible path to it. By 1999, it was flowing to companies with a domain name and a slide deck. Watch the same transition in AI. According to PitchBook, 498 AI companies now carry unicorn valuations of $1 billion or more, with many having no clear path to profitability. And the narrative becomes unfalsifiable when every piece of negative news is reframed as a reason to be more bullish. The story has detached from the data. DeepSeek's surprise emergence in January 2025, which briefly wiped $600 billion from NVIDIA's market cap in a single day, was reframed within weeks as proof of AI's growing importance. That reframing is the signal, not the reassurance. Identify the traits of durable businesses before the crash, not after. After every major mania, investors look back and find that the survivors shared common characteristics. The problem is that these traits were visible before the crash. They were simply ignored in the excitement of rising prices. History points to 4 that have consistently separated survivors from casualties. The survivors solved a real, current problem, not a projected future one. Amazon in 1997 was selling books online, today, to customers who paid immediately. That was a real problem being solved for real money. Most of its .com contemporaries were solving problems that would only exist if several other things first happened. In AI, the equivalent question is, does this company earn revenue from customers with a real problem today, or does the business model require AI to work in a way it does not yet? They held a genuine competitive advantage, something that made the business harder to replicate over time, not easier. In the railway era, it was rote exclusivity. In .com, it was network effects. The more people used eBay, the more valuable it became to every new user. In AI, the question becomes whether a company's product becomes harder to displace as it grows, or whether it is one API update away from being replaced by the next model. Blue Whale Growth Fund's CIO Stephen Yu captured this cleanly in December 2025. I would not want to position into the AI spenders. I would rather be on the receiving end, companies benefiting from AI spending, rather than dependent on AI outcomes, carry a fundamentally different risk profile. They could survive a funding drought. The companies that collapsed in 2001 and 2002 were not all bad businesses. Many were simply businesses that required continuous external capital to survive. When the markets closed, they had no runway. The survivors had reached a point where operations could sustain themselves. In any mania, the moment to ask this question is before the drought, not during it. OpenAI's own projections show $74 billion in operating losses in 2028 alone, funded by debt and investor capital. That is not a company that can survive a funding drought. They benefited from the technology shift without depending on any single version of it. NVIDIA is instructive here, not because its current valuation is necessarily justified, but because its underlying business supplies the tools that every AI company requires, regardless of which AI company wins. In railway terms, it is the steel manufacturer, not the railway operator. The steel was needed, whoever laid the tracks. That structural position, supplying the revolution rather than betting on its outcome, has proven durable across every prior cycle. Here is what the history make clear. The AI revolution is real. The technology will reshape industries, restructure labor markets, and produce companies of extraordinary long-term value. None of that is in doubt. But in every market cycle where a genuine revolution arrived, the same division appeared between investors who understood the technology and investors who understood the pattern. The railway transformed Britain. But most railway investors were ruined. The internet transformed commerce. But most .com investors lost. The pattern is not that revolutions fail. The pattern is that revolutions succeed while most of the capital that funded them does not. Today, AI-related capital expenditure accounts for roughly 1.3% of US GDP, a share the GMO Research Library has described as potentially the greatest capital investment bubble of all time. The share of the US economy devoted to AI investment is already nearly a third greater than the share devoted to internet investment at the peak of the .com bubble. That is not a footnote. That is the scale of what is unfolding. The bubbles always finance the revolution. The speculators always pay for it. And only the builders collect. The internet did change the world. But in every market bubble, history reminds us that innovation and speculation are never the same thing. If that raised questions you want to think through, drop them in the comments below. The most useful conversations on this channel happen there. If this gave you something valuable, share it with someone who needs to hear it before the next phase of this cycle arrives. And if you want to keep reading history's patterns before the crowd does, subscribe. There is more where this came from.